G'day, I'm Nic Earner, the manager of Alkane Resources. We're a gold production and exploration company based in Australia, ticker on the Australian Stock Exchange as ALK. And we operate a gold mine called Tomingley in New South Wales. Produces at the moment nearly 60,000 ounces per year, but we're expanding through to 100,000 ounces per year. Looking forward to talking about it.
Well, we're going to talk about it right now. It's an exciting time for gold in Australia. It seems to be a bit of M&A happening, mergers of equals, and not many other people getting much attention. So you've just announced a 5-year plan for Tomingley. Tell us about that. Why? What's it going to do for you?
We first discovered these deposits immediately to the south of our existing mine, which is about 4.5 hours west of Sydney. We first started drilling these in 2018. Right, so we've been running the mine since 2014. Started drilling them in 2018, and then did the usual stuff. Drilled out to inferred, then indicated, then here we are today. Reserve. Went through all the approvals processes, which I'm more than happy to talk about. As you can imagine, all this stuff takes a fair while. Did an exploration decline over 2.5 kilometres to get there, and we're mining that ore body right now. So we put out this 5-year plan that says, okay, what are we doing about that? How are we going to develop underground or further beyond, given we're already there? What are we going to do with the open cuts? We have to move a national highway about 1 kilometre to the west as part of that. And most importantly, what's the cost of that? Because we first really, told people about these costs in 2021. We've done a lot of things in the meantime. We've done a lot of work, but we've also added some different bits and pieces to scope. But the whole purpose of it is to extend the mine life out. We put out a 5-year plan, but the mine life goes out currently to 2032, but we've obviously have a possibility to extend that. That's what we're doing.
I think it's really important to actually understand the process you've got to go through. We've seen in Canada recently a massive failure of a heap leach pad. I know you're underground, but the principle is the same. You've got to do things the right way, because anything goes wrong, the knock-on effects are catastrophic. In this case, I think the Victoria Gold, they've lost 85% of their value literally overnight. So in terms of this kind of stage process, I know you announced the 2021, but it takes time. So what have you done to date? What more have you got to do?
Yeah, so we have already an existing processing facility that processes 1.1 million tonnes per annum of fresh rock. We had 4 open cuts that we've finished, and we have an underground under those open cuts. 2.5 kilometres to the south, we have 2 new deposits. We call them Roswell and San Antonio. We've got an underground drive that's already there. We've got levels developed. We've got the vent fans in, the crib racks, normal stuff. And we're stoping that new ore body as well as under our existing ore body at this 1.1 million tonnes per annum rate. So for a while, we didn't have this new ore body. It's higher grade than our existing ore body. And so we're producing that around this 60,000 ounce rate. We've produced, more than that in the past. Now we're moving up to a 75,000 ounce run rate. But what do we have? We have a processing facility. We have approved mining leases. We own all the property on it. We've got a developed underground mine. We've got new area coming on. We've got tailings capacity. A new tailing dam has been built and constructed to all, as you can imagine, Australian standards are very high for that kind of thing. Flat land. We've got the water supplies. We've got the power supplies. And we're expanding. We're halfway through putting in a paste plant, and we're halfway through putting in a flotation and regrind circuit to lift recovery. And what we've done is we've just outlined our next steps as doing the open cuts, moving the highway and stuff like that. So we have, a lot of things already in place. And we're just really articulating to people, what's the timing and cost of this next year and a half?
Tell me about the wet paste plant, because that's kind of interesting to me, because it's... explain to people what it's for, what you're trying to do with that, and why that was a good allocation of capital for you.
Yeah, so first we'll talk about a paste plant. Many people that listen to Crux are already, technically abreast of this kind of stuff, but to recap for anyone that isn't, in an underground ore body, let's think of a typical orogenic gold system such as ours, a vein type deposit. So we might go between 3 metres wide and in some cases, 25 metres wide, right? Long strike, couple of 100 metres, and we want to, this is all mineralised. It's more than 0.5 gram in our case. Our cut-off's 1.5 grams, but gold in the middle, right? And so, typically, you can imagine when we remove that space, the whole earth wants to crush in on that space. If we think of those pictures of old timers with jackhammers and stuff, they put timbers in to keep it open. Or you can put rock fill, or you can just leave it open, put rock fill in it, and then for structural sake, you leave it what we call a pillar. So you leave a block of ore that you don't mine. Now, in a patchy ore body, that's perfectly fine, costs less money, and this bit you leave behind, typically you don't want to mine anyway. In a high-grade ore body like we have at Roswell, you need to take that out because that's just money sitting there and you paid all this money to develop it, you want to take it out. And a very modern way to do that is you fill it with paste, which is basically your tailings material mixed with cement to form a low-strength cement, enough that as you compress it, it won't move, enough that you can drill up beside it and blast the rock out beside it, leaving a sheer face of cement. That is what paste does, and it's distributed from the surface. You can imagine there's this great hydraulic pressure to move effectively, concrete, like you see in a concrete truck building an apartment block or something around town. And but that comes underground, and it's, very fine material. It forms this loose paste. You build it in stages, and it just forms part of your mining sequence. So, drill, blast, bog, fill with paste, and that becomes the sequence. And so we'd originally thought, we'll build a dry paste plant, which means you mine old tailings, mix it together, and put it in, and hire the equipment. We thought that would be a cheaper alternative. But the longer we went through this process, the more we realised the flexibility, the lower operating cost, particularly in terms of cement demand, and the ability to move it around easier, and the fact that we could pipe it over there just made this more and more attractive. It's a $30 million project that pays for itself very rapidly.
Right, okay. And I appreciate us getting a little bit technical, but I say for those who perhaps have not discussed these things before. One of the things I have discussed recently is sitting with a few fund managers and, reminding myself from my banking days that as a producer, in a very meaningful way, I don't really care about the admin of what you're doing. Right. Yeah. So you got a 5-year plan, and it's highly technical. You've got to do it precisely and efficiently and all of it.
And it's all very interesting.
It's very interesting. However, what I care about is the ounces, right? So 60,000 ounces going to 100,000 ounces. That's what I care about. Quarter over quarter, delivering against your target in an efficient way, where you're making increasing margins. That's what I care about. PE ratios. That's what I care about. So I'm going to maybe take that kind of commercial view now with this conversation, which is
totally.
So talk to me about the timing and the ramp up from moving from 60,000 to 100,000 ounces.
Yep. So let's say everything we've done that we described during our conversation, let's call that behind us. We've spent money on it and it's gone, right? So we have, between now and being at 100,000 ounces, with open pits operating, this paste plant going, we've expanded the mill, it's another stage of stuff. We got 132 million bucks Australian to go out the door. Right? At the moment, we have a $60 million debt facility. Everything I'm talking is in Aussie dollars. We have a $60 million debt facility, which we're in the stage of drawing, and it will be fully drawn by next 3 or 4 months, right? So we'll have a $60 million debt. What we'll then do, at the same time, of course, we're producing gold, and we're ramping production up to the run rate for this underground is moving to 75,000. So we've got free cash flow coming in. We expect to upsize that debt to circa $110 million sometime over the next year, draw on that again, and then repay it in the subsequent 3 years following that. Our all-in sustaining cost, we will average around 2,000 bucks Australian across that period of time. So what would that be in US? That would be around, 2/3 of that, whatever that is. So, around 1,300, 1,350 US is what our all-in sustaining costs would move to, which is higher than we want. But we've talked previously before, and you would talk to many other producers. The cost base has shifted quite a bit over the last 4 or 5 years, 3 years within Australia. And that's what's going to happen. And the all-in sustaining costs, of course, because we're doing more development underground early on, starts higher, starts at 2,400 Aussie, so that would be 1,600 US, and then it falls down below that average across that period of time. Yeah. So margins-wise, we would expect to make Australian swings and roundabouts if the gold price stayed where it is at the moment. Over this 5-year period, and realising, of course, the mine life goes beyond that, over this 5-year period, we expect to make 500 million Aussie. Yeah.
Okay, so in terms of the balance sheet, it will start to be very, very healthy. You'll start to build up a kind of maybe even a cash reserve. Who knows, depending on what your ambitions
From 2026 calendar, it starts to build up. Yeah, correct.
Right. Okay. And I think it's a case of, walk before you run, right? So you've got enough on your plate here. I referenced right at the beginning a lot of M&A activity, Westgold, Karora, Ramulus, etc. And we're seeing it, globally. This, the producers, of which you're one, but are starting to look around because they're getting increasing amounts of cash. I think for you, you're not quite of that scale yet. So I guess there's no expectation around M&A anytime until you get post this 100,000 ounce level, presumably.
That's absolutely true. That doesn't stop us from looking, right? So, of course, we had this period in 2018 where we invested in some projects back then. So we have this really interesting conundrum, right, where if you're a developer, so not us, who's a producer who is doing development, but an actual developer who does not have production, it's very hard to get money for love nor money. You're taking steep discounts. It's a very difficult thing. It's hard to convince the market. It's hard to get them to take risk, right? And so we're looking at those type of companies again in Australia at the moment, because even though our own balance sheet, would come under pressure, well, nowhere near as much pressure as these, and we can take potentially positions that allow us to get a couple of years head start on future growth. So that's sort of part one. Part two is companies like ours, which is single mine companies, we're sort of always in the market. Is there someone you could come together and a merger of equals, right? Where, you've got projects at different timings, project different life, project different grades, different locations. There's really only tends to be corporate synergies. But, if you can shave $5 million out of your corporate costs, it's meaningful in a junior, right? That's if you're making 100 million a year, we would make more. But, that's 5%. 5%'s not to be sneezed at. So, we're constantly on the lookout for that, regardless of what stage we're at. But I don't think that makes us unusual, Matt. Yeah.
No, it doesn't. Yeah, look but don't touch, right? At the moment, you referenced something that was kind of interesting to me in terms of the way that the money is currently viewing projects like this. It's definitely harder. Obviously, the costs have gone up, but the margins have stayed broadly the same, if not a little bit better. So that's good news for those who are efficient. I agree with you. I think the US and North American guys are talking about 1400, 1450 type ASIC, which is in line with what you just said, and probably in line with what you're aiming for. But bankers are having to like for me, back in the day, I'd be looking very carefully at the sector and going, well, there seem to be a few things blowing up here, not just balance sheets, not just economic studies, but actually mid-process build blowing up. People are getting it wrong. Like we'll reference Victoria Gold and getting that very wrong on their heap leach. Seeing people get the tailings side of things very wrong. Are there the same amount of funders out there for banking for companies like yourself as there was, or is Australia a sort of healthy environment?
Yeah, really, really good point. So obviously, like all things, it depends on the project, right? So, the larger projects with the good grades, if you take De Grey, right, just today they've announced that they're putting together $1 billion package for Hemian. They won't, despite the fact that that's going to need, intensive leaching and some sort of oxidative cracking of refractory material, they'll pull together that package pretty readily, and it'll have, big names in it. For companies of our size, Macquarie Bank continues to be very active in the sector. They have a mining team that sort of, gets mining and understands stuff and does their own reserve analysis and stuff like that. But a lot of the major banks and other players have really withdrawn out of unless they can be part of a larger syndicate, right? So I think it all comes down to you need incredibly good project metrics at the moment to get conventional bank debt within Australia. If you're a larger project or part of a larger company, sure, of course. If you're a small or a medium company with good economics like ours, and you can attract Macquarie, maybe one or two others. If you're a small developer that people are worried about, or people are worried about the risk, or they think the team hasn't done it before, or your estimates are old, whatever it is. Yeah, very difficult. You'll struggle for that, and you might get pushed into, quite a difficult hedging position, or, quite a difficult dilutionary event because people just want less debt leverage.
Yeah, I think I've spoken to one of your Western Australian compatriots who has debt from Macquarie, and I think they've refinanced it twice now, but they've had some delays, shall we say, and that doesn't reflect well not only on the company but in terms of the sector, as part of their build out. So that's why I was wondering is, to the banks, are they taking just that little bit more time to allocate debt packages, etc.?
It depends on the project. For someone like ours, brownfields expansion, existing mine running the whole time, it's a lot more vanilla,
Yeah, I guess. And the other thing I was looking through your PowerPoint. I mean, if you look at all the earthworks and build and plant, and so you've got a lot on the ground. How much has been spent today? You talk about maybe $500 million build up, but are you making? Have you made money yet?
No. So, I mean, of course, it depends on what time frame you're asking that question. Are you saying just on this particular expansion, or right back since the dawn of time?
No, right back. Just how long? Because it comes back to this thing about, and so I'm just trying to answer the kind of commercial reality of these things, and why banks think twice. It just takes time, not only to get the license to build these things, but make the money, return on the capital invested.
Let's talk super broad numbers then, right? Because I don't have all the numbers, right in front of me. So if we just say that the exploration dollars spent before 2012 are sort of gone, right? And that, $10 million, whatever it was. So we built Tomingley, including the open cut pits, for a circa $120 million, right? Back in 2013. And then it was in 2016, roughly, that we had paid back that, even though we didn't take out debt, right? But we paid back that $116 million. And then we made a lot of hay in late 16, 17, 18, right? And we ended up with a cash balance of over $100 million. And at the same time, we were funding the Dubbo project, ASM, right? So we went to nearly $150 million in plus cash. From there, we spun out ASM, which was like a dividend to shareholders in a sense. We discovered the Boda porphyry, which we obviously are working on the scoping study, very final things right now. And we did all this drill out and development. We've only just drawn, and we kept running the mine, and we've only just drawn $60 million worth of debt. So, and we had other investments and stuff. So the reality is, outside of the actual dividend of the payment to ASM, or a payment of shares for ASM, which people could either sell or hold or whatever they did with them, and the yet to realise dividend of the Boda project, which we've spent circa $60 million on, right? Outside of that, shareholders have not yet made money. This is the real point, to make money for us. So from this point, like I said, circa $500 million at existing cash rate, we can think of, the reality is, and it's very difficult to quantify the amount of money, but we listed it ideally at $130 million, right? Tomingley has operated to get this value on Boda and ASM, and get itself in the position, minus 130 still to come, to make $500 million. $500 million includes 130 taken out, right? So it's very difficult to put that in a percentage because of the way our corporate activities have moved. But if we just say that the money that was spent on it went as a dividend, and we effectively put 120 in at the start to pay out a dividend of nominally 130, to now be at the position where we stand to make $500 million net over the next 5 years. I hope that answer's clear when people listen to it.
Well, as much as it can do, yes. Yeah. It gives a sense of it anyway. Look, so can I just talk about your share register? I promise this is going to be relevant to what I want to talk about. What's the share register look like in terms of institutional?
Very low in institutions. So we have approximately a bit over 10% is international institutions, and a lot of them are index funds, and a bit under that in Australia. So circa sort of 20-25%. Quite a few of them are ETF style index funds. Yes.
Right. So let's talk about what those guys typically like, because you're that phase. You're a producer, right? So it's great. Yep. You got revenues, and it shows that you know how to build stuff and you know how to mine economically. So it's all good. Yep. But to kind of move through to that kind of change that kind of profile, and the sense you want more institutional money coming in here, ETF or otherwise, you're going to need to meet certain conditions for them, and one of which is the life of mine. The extent of what you've got available to you. So, and I know you're conscious of that whilst you're going through this kind of capital program allocation, but exploration's got to be important to you, because did you say 2032 at the moment? Is that the current?
So the mine life's approved to the end of resource, which is 2032. You can seek extensions, but yes, let's call it that.
Right. Okay. So what is so from my day back in the day, if a company didn't have at least 10 years, I would like, nah, I'm going to give this a miss, right? So maybe there's a little bit of that out there. So what do you do, and how much do you allocate to changing that?
Oh, absolutely. Well, West Australian gold producers, indeed Australian gold producers, there's not many, even sub 2 billion that have got, resources out to 10 years, right? So a lot of people have, between 2 and 7, depending who they are. But so we at the moment are allocating 6 million to exploration regionally and in and around Tomingley. But we've just come through a period of, at Tomingley, so at the gold mine, allocating close to $20 million a year, right, to get us to this point. But underground, we spend another $4 million doing resource extension work, including some quite. I mean, we don't call it exploration because it's in and around. It's within the mining leases, but it is effectively exploration from within the mine itself. So we certainly do that. And one of the reasons is, obviously, in and around the mine, we've got approved mining lease where you're simply looking to extend the life with the regulator. That's all pretty vanilla, right? But let's say down the road, and we've got, exploration tenements all in and around us, but let's say we find something that, again, is another 4 kilometres away. Well, we who know our way around the regulatory system very well, right, from discovery hole to resource drill out is, 2 years. Then you've got environmental studies and land access and, purchases and agreements with the farmers. And then you've got going through the actual approval process. And in our case, we're feeding an existing processing facility. That was 5 years, right? So, yeah, absolutely. We're regionally looking. We of course think we'll get extensions around the mine, but we've got to understand that somewhere in the 5 to 10 year timeframe, we need other external resources, right? Because we're going to have to go to the regulator and get them approved. And we're not the lone ranger in that Australia-wide or indeed internationally. But yes, certainly, that's the kind of runway, right? A company like Ramelius, who's, very well run, very, very savvy, they've purchased satellite mines that they've brought on within that time period. They've brought them on within 2 years, but that's, sometimes even 1 year, but that's not including, in doing that, I'm not including the time that the person they bought it off has taken to get to that point. So absolutely, all miners, if they're not acquiring, need to at least have a 5-year look ahead. Sorry, in a Western jurisdiction. Yeah. Moving, yeah. Yeah. Yeah, so the things, done apart from construction. So back in, I'll just say 2020, 2021, but I can't really remember, mate. We bought the 7 different farms that the mining lease falls on, plus where we need to move the Newell Highway to. And so we own those farms, they're wholly owned. And then we applied for what's called a works access deed as part of the project approval process into the Transport for New South Wales, which is the government regulator that does transport, and got that signed off. You have to negotiate that. That talks about how one would go about building the works. Then we submitted designs for the works, and then we went, you have to slowly move them through different percentages of design, taking with the government's designers, as well as an independent third party, which is part of the works access deed. We've reached 100% design. So what we have is wholly owned land, agreed and fully project approved, with the instruments that are needed, and all we have is finalising the contractor to build it. And we're in the late stages of that tender process. So, yes, there's quite a bit to be done. It would be so good if it was as easy as sort of Google Maps, you like to drag the line. But, yeah, it's quite a lot of work to do.
I like the image in your PowerPoint. It's almost like you drawn a line and it's squiggled.
Yeah, exactly. Yeah, that's what we did. We don't tell anyone. We just went, what about here?
You're not wasting money on designers.
No, that's right.
It's all going in the ground, folks. Right. And let's just want to finish off with, ironically, the final investment decision. Yeah. You kind of use a little phrase there, depending on gold price. You will, I guess, you're starting to commit to those kind of expensive purchases, etc. To do that, you're going to need your balance sheet in a fit state. Do you think you're there, or would you be looking to maybe check things around?
We're there, but three things to happen before then. The first one is that we go and negotiate an expanded debt facility, right? Part one, of course, so that the balance sheet's ready. Number two is...
and by the way, while you're just explaining to people, while you're extending it, you're restructuring it clearly.
Yes.
Given you've been de-risking since you last did it, do some of the liens fall away? Do you get better terms?
We already have a very flexible, conditions precedent and conditions debt. So probably not in reality, because we're really quite flexible. There's no cash sweeps or any of this other stuff, right? So right, probably not. We put that debt in place. Number two is, of course, we look at the forward gold curve, which is part of the whole debt. But if the whole world was saying, oh, actually gold's collapsing back to 1,300 US, it'd be like, oh, probably we wouldn't do that. We'll come up with a different thing, right? If it's occurring within this debt repayment timeframe. That's a massive shift from where we are today. Or two, costs associated with what's occurring within Australia are just taking off for some reason. I don't think so. We're flirting with recession, so that's unlikely. But what I'm saying is, the final investment decision is not a decision if the status quo of today remains, right? It really is saying to everybody, hey, there is a point which we will, of course, review at, where we say, has the debt gone well? Is the gold price looking solid? Is the costs forecasting looking solid? In which case, we plough on. We will, of course, undertake all the activities as if that's occurring, because otherwise we just lose time. We'll be engineering plan expansions, we're buying long leads, we're doing tenders, submitting stuff in management plans to government, all the other stuff you have to do, right?
Okay. I'd say the other point, again, back to my banking days, was like, I may have required a certain life of mine, but it also requires a certain amount of ounces. Once you get past this 100,000 ounce point, should you get past the 100,000 ounce, it puts you into a different category, a different league. I guess your expectation that there might be a re-rate. So, and the message now is get in early and take part of that in that leverage. So the time frame, so when are you saying that you are aiming to be able to get to 100,000 ounces? I didn't quite catch that earlier.
We should, if all things go smoothly, next financial year, right? So from 1 July, a couple of days, some people might even already be July when people watch this, through to the middle of 2025, we should do, 70 to 80,000 ounces. Then the year after, which is the year that we finish the construction of Moving the Highway, because this occurs across calendar 2025, until So FY26, middle of 25 to the middle of 26, within that financial year, everything should be concluded within the middle of that year, right? And we start to ramp, and our guidance there is, circa 80, 90,000 ounces. And then the year after that, so we'll call it calendar 26, but at FY27, then that's the point at which we really kick away. So 18 months from today, we should be really kicking away. Yeah, absolutely. And so, of course, you look at our share price, and you touched on this a little bit when you last spoke in London. Nobody likes the kind of risks that we've chatted through, right? It doesn't really matter to people that we're an existing producer, that we've done this stuff before. People think, well, when it's done, then it's de-risked, and then I'll have a look at it, and when I see the cash flowing. And a lot of investors don't really mind if the share price moves. If they think, oh, well, the share price might double then, we don't really mind if it moves 25, 30%, if that 100% now, because we'd rather have it de-risked. So, yeah, it's one of those tensions, I think, depending on people's risk appetite. I always spoke about right at the start.
Yeah, true. And certainly for institutional boys and girls, they'll probably be doing exactly that. So I want to make sure I haven't conflated data, because you were talking earlier about the mine project approval to 2032. I was assuming that also kind of referenced life of mine. It probably doesn't. So is there a kind of life of mine date?
Yeah. So the life of mine date is very, very similar to that. Yeah. So the life of mine is at the start of late 31, early 32. One of the reasons I previously talked life of mine plans. One of the reasons I went for a 5-year plan in this is, if you look at things that we have left to do at the end of this 5 years, right? So, late 2029, we have the Roswell open cut, if we choose to do it. We have undergrounds under San Antonio, should they prove up. We have depth extensions at Roswell, which at the moment are inferred. And we have depth extensions under the existing eastern side of the existing pits, which are also sitting inferred. As to which one of those is the most cost-effective ounces to be bringing to the plant, I don't really know, right? And so I thought, you know what, the next side is pretty certain. After that, there's plenty of stuff, but it's pretty grey. I'll focus on this next 5 years, and then as we get more definition, that'll keep people, updated with time.
Brilliant. Nic, I appreciate the update, and thanks for kind of digging into the weeds a little bit around the economics of the thinking around how you optimize. Hopefully we'll see you soon.
Yes,
maybe even see you in Denver in September if you're going to go to that one.
Yeah, well,
like
we should have spoken before then about Boda and Kaiser. But yeah, I'll see you again in Denver.
You're a star. Okay, Nic, good to see you. Cheers.
Thanks, Matt. Cheers, mate.